Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman and Wakefield's #1 investment sales team.
Hi, I'm Jon Hageman, Executive Managing Director at Cushman and Wakefield. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, Chairman of New York Investment Sales, and today we're going to talk about how the recent tax policy changes are going to affect the New York investment sales market. Let's talk about some of the specifics that we've seen and what we believe is going to happen as a result.
This tax policy change does have a very, very profound impact on the market. If we look back and see how tax policy changes have impacted the market in the past, they've always had a very, very significant impact on how the market has played out.
Bob, for the viewers, just touch on a few of those historical tax changes.
Sure. Well, let's go back to the mid-'80s. The natural peak of the market from a volume perspective in the 80s should have been 1988, but tax reform of 1986 made people accelerate their selling decisions because tax policy was going to be changing. So we had a huge spike in activity in 1986. 1998 was another year in which there was significant tax policy changes. The administration lowered capital gains taxes from 28 to 20%. Huge spike in the volume of sales in 1998, and then again in 2012 we saw on the anticipation that there would be a 3.8% covert capital gains tax embedded in Obamacare led to a rash of selling in 2012, so we had another spike.
So what is this most recent tax reform going to mean for the market?
Well, I think from a commercial real estate perspective, the tax changes have been very, very positive. Number one, the preservation of the 1031 tax-free exchange. But if the 1031 exchange had been eliminated, I believe the volume of sales would have fallen to probably 0.5%. We would have gone on a one-year vacation probably and enjoyed ourselves while nothing was going on here. So the preservation of the 1031 exchange was probably the most important thing from our perspective in terms of keeping the market in a good position.
What about some of the other changes that affected it?
Those two changes, the fact that 1031s were preserved and the fact that carried interests are remaining taxed at capital gains rates, were very positive for the market. Probably the biggest change in tax policy that's going to be positive for the underlying fundamentals of real estate is the fact that corporate tax rates were cut so much. If you consider that the average profit margin for companies in the U.S. is 10, 12%, the reduction in tax rates has effectively doubled the profitability of these companies. That is unbelievably impactful on the decisions these companies are going to make in terms of how they operate their businesses. I know when Paul and I were running Massey Knakal, if our profits were going to double all of a sudden, we would have gone out and hired a lot more people. We would have taken more office space. We would have bought more computers. We would have made investments. We would have done a lot of things with those proceeds. And indeed, we see companies doing that. We see companies committing to building new plants, hiring more people, paying higher wages. These things are all very accretive to the activity that we have in the economy and are going to help the underlying fundamentals of real estate. And then lastly, the fact that pass-through entities will be able to shelter 20% of their income is also a very positive thing. So I think that tax reform will serve as a buoy for the market. Not having the decline in volume continue for another year or two as we would normally expect based on what history has shown us. And I think it also will serve to prop up value a little bit.
So Bob, it sounds like you're saying that we expect volume to go up a little bit, but value will come down. Have we ever seen that before?
Yeah, well, it's a very interesting point you make, Hags, because normally when value is falling, volume falls. After we're in the correction for a while, sellers become acclimated to the new reality. They understand that if they want to sell, they have to meet the new pricing. So I think this overall bodes very well for where we are in the cycle, and 2019 should be a really bang-up year. So, you know, if things play out the way we anticipate, 2018 should be good, but 2019 should be really, really good. So really looking forward to that. In summary, the changes in tax policy will be very, very good for the commercial real estate market. preservation of 1031 tax-free exchanges and continued carried interest tax treatment will be very positive for the market. Importantly, for the underlying fundamentals of the market, corporate tax rate reductions should be very positive, as will be the deductibility of 20% of income for pass-through entities that own real estate.
Thank you for joining us today. Tune in next week for another episode of the Knakal News Network.